Everybody good? All right. All right. So how many thinks the market's going to go up? How many thinks the market's going to go down? How many doesn't give a crap because you can make money either way? Right? That's what I want to start with. I don't care if it goes up. I don't care if it goes down. I just need to know which. Right? Does that make sense? Because we can make money in either market. That's the beauty of real estate. We can make money whether the market's going up, whether it's going down, whether it's going sideways. But I do need to know which one it's doing so I know how to play the game. Does that make sense? So that's really what we want to talk about tonight. My disclaimer, I'll start with that because I know that's the first slide. Try to do this by memory until we're ready to roll. I don't have a crystal ball. All this is just one man's opinion, right? I'm not giving any tax, legal, or investment advice because I'm not qualified to do that. Seek that said advice if you need it. Don't say Tom said to do it. Disclaimer done. I think that'll cover it. So we'll talk a little bit about 2021 and what I said in early 2021 that I thought.
I don't mean to interrupt you, Tom. Can you click next just to see if it goes through? Go back one. All right, Bumblebee 2 now.
Sweet. Thank you, Derek. Thank you, Derek. All right. So I like to start every year. And by the way, I was trying to calculate. I think this is my 12th or 11th year of doing this. I hate doing it. Just full admission here. Because I put anywhere from 8 to 12 hours into it every time. And I hate that. I continue to do it for you all, because if I'm doing it for you, I'll actually do it. And then I get the benefit of it. So I'm using you to force me to do it. So I have the data to use in my own business. Is that okay with you? And that is the honest to God's truth, why I do it, okay? Because if it was just for me, I guarantee you I would never put the time and effort into it. But because I've committed to doing it for y'all, I actually will. So 2021, year in review, there was quite a few changes last year, right? We just come out of a crazy year, 2020, where we learned new words like social distancing and you know, what was it? There were, just crazy stuff that we'd never really had to deal with before. And I thought, man, that was probably the craziest year, you know, we'll have for a while. But we had some crazy stuff in 2021 too. Oil prices started to rise. That was a good thing if you're a Houstonian, right? Because 30% of our economy does rely on the energy industry in this metroplex. And then we started picking up jobs, which was great because we'd lost so many in 2020. Then we got this thing called Omicron. Like it just, oh shoot, well, now we got to shut everything down again. Now we got to stay home. Now we got to put masks on. Now we can't fly again. And by the way, we lost a bunch more jobs. Then back up and we started putting more on. It was just such an up and down teeter-totter year. And then this new word that most of y'all that are under my age have not really heard much about, called inflation, started coming up. And I say y'all hadn't heard of it because, you know, folks your age, Lindsay, you haven't lived through it yet, right? Younger folks than, what, 50, right? Haven't really lived through inflation. I mean, I did, but I was a kid. 70s, early 80s, I graduated high school in 83. But now we're seeing inflation. Now we're seeing it in a big way, and we'll talk about that a little bit. So before we get on into all of that, I gotta put my slides up from last year, my conclusions, and see how I did, because that's the only true way to keep me you know. So my conclusions from last year, and this is what I said, I'm not even going to hazard a daggum guess at what GDP and job growth are going to be this year, because everything was so crazy. It's the first year I didn't even take a stab. So I got it right. Would you agree I was right on that one? Since I didn't take a guess, I got that one right. There were just too many unknowns, too many variables. And as we found out with COVID, right? Those variables, those what we call black swan events, can really change your life on a dime. And I think we've got some more black swans coming that we'll get into here in a little bit. But I did say, but I do know this: Houston single family real estate is still going to be strong. I was positive of that. And that was a really easy bet. Why? Supply and demand, right? I was really going more towards the supply side since there wasn't any, right? So that was a really easy prediction to make and be correct. I said that retail real estate should remain strong. It did. That we set records last year. Prices should continue to rise. Boy, did they. I kind of undercut that. Didn't realize they were going to go up that much. Sales volume might slow due to lack of inventory. It didn't. Even with the lack of inventory, we still eked out a record year last year. And not eked out, that means we barely hit a record. No, we smashed it. We literally smashed it. And that's why prices went up. That's right. That's right. That goes to the demand side, Ed, what you were just mentioning. Single family rental market should also remain strong with low occupancies. That I meant vacancies there, not occupancies. That was a misprint, obviously. And continued increase in rents. And it did. The rental increase on the rental rates was staggering. We'll get to that slide here in a minute too. Multifamily properties may see some trouble. Opportunistic and financially challenged tenants are more prevalent in multifamily than single family. And my prediction here was that some people might just not pay their rent, even if they could. And I was just talking to somebody prior to the meeting who was in a syndication, and they had that very same thing happen that we predicted. And that syndication will probably lose money. And he said, if we break even, he will be happy as a result of that. Not because of the operator, not because of the syndicator or sponsor or anything he or she did, because of the tenants and how they reacted to the availability of just living free. And that's basically what it was. My 2 cents on that entire thing is that the United States in 2020 eliminated property rights in America. Property rights in America were eliminated in 2020. And we'll look back on that day a few years from now and realize that. Just my food for thought. Class A apartments, I felt that we'd see increased vacancy. I was wrong. We do not see increased vacancy. We've blown right through that. And by year in 2021, I said total multifamily occupancy would be hovering between 87 and 88%. And if that occurred, you could expect to see more sales transactions take place. It actually ended the year at 90%, one click above where I thought it would be. And now in March, we're at 91% in multifamily occupancy in the metro area. Last slide from last year, lack of supply in single family homes. Get out in front of it any way you can, because if you build it, they will come. And what I was talking about was if you can get a hold of a property and flip it, do it, because these prices are going to keep going up and you're going to be able to sell it. See, when I got into real estate back in 2008, we had the opposite problem of what we have today, right? I could buy houses for, some of you guys started when I did. Normally, I see a lot of familiar faces from back in the day when I first got started. I mean, we were picking stuff up at 50 cents on the dollar minus repairs all day long. 65 was my max, and that's if I loved the property, right? The problem was once we got it fixed up, who the heck you're going to sell it to? Nobody could get a loan, right? So we had the exact opposite situation as what we have today in today's market. If you can get a hold of that property, just get a hold of the dang thing. If you can build a house because you're going to be able to sell it. And that certainly was the case last year. I think it's also the case this year. We could take everything off of this slide and put it on at the end of this, because I think we're going to see the same. Watch for deals in C-class multifamily. A few of those are starting to pop. We've actually been lending on some of those. I haven't seen a good multifamily deal in a long time. We're starting to see them. It's not because of distress either. You might think that's what it is. No, it's because people are wanting to cash out and take their chips and move to a different table. The values have gotten so high. These guys that have owned them for 20, 25, 30 years are like, you pay me what? Okay, right? And that's how the deal goes. And yes, these need repair. They need, because they haven't been updated in forever and stuff like that. So guys are getting them at a discount to current market. I'm not going to say it's a great deal, because I don't know what your definition of a great deal is, but I can tell you they're getting them at a discount to current market prices. Small retail and single tenant commercial opportunities may start to pop, and they are. That is where I'm playing today. That's my sandbox. I love that sandbox. I'm going to love that for the next couple of years, I think. I just flew back yesterday from Pittsburgh. I was over there looking at a deal. There's some really good stuff out there right now. Really good stuff. And then we'll definitely see opportunities in smaller office buildings. Again, if you're in a small office, they're a dime a dozen. They're like buying houses in 08 and 09. Problem is, what are you going to do with them? What are you going to do with them? That's the question. If you can answer that question, you could get some really good deals. So that was from last year. I didn't calculate my percentage of accuracy there, but I wanted to share it all with you. So I'm going to talk about Houston today. When I do, I'm not talking about the city limits of Houston. I'm talking about the Houston MSA, which is 9 counties surrounding the city of Houston, right? So when I talk about Houston, I'm talking about the whole Houston proper. This is fascinating. I shared this a couple of years ago, and I always go back through the last few years of these when I'm putting this together. And I love this slide. I wanted to put it back in this year for those of you that don't remember or maybe weren't here. Houston, as a rule, this area has about, at any given time, 3 million jobs, which is more than what is had in 35 states. Not combined, but Houston alone beats 35 different states for the amount of jobs we have just in our little 1 hour by 1 hour metroplex. Is that crazy or what? That's just absolutely crazy to me. On net, about 60,000 people a year move to Houston. Now, if you think about that, that's about 165 new people a day on I-45 and I-10. Okay. So if y'all were wondering, what the heck? There you go. Right there's the stat. It just, our over 65 population in the Houston metro grows by 30,000 people a year. So aging demographic. And we'll talk about that as we get into this a little deeper as well. So just some silly facts to share with you there. So Houston GDP growth for 2021, we had positive growth. Now, this also depends on your definition of positive too, right? But we had positive year-over-year growth, and that's how all these stats go. I heard one time that figures don't lie, but liars sure can figure. So when I started doing this and really researching the economic data, I understood that I had to do more than just Google a question and write down the answer. I got to understand who put the data together, what is the objective of that person or group that put the data together, what is their agenda, and then how was the data collected, what was the metrics behind the data, because sometimes data can be used to give you a spin that isn't real. Would you all agree with that? And I really, really have to look at data sideways when it comes from a federal government source. I know, who would have thought, right? But sometimes I find an agenda behind the data. Okay, so everything that I'm going to share with you that comes from government sources tonight is going to talk about year-over-year growth or year-over-year loss. But when you have a COVID year, 2020, where everything fell to heck, and then you come back and say, Houston grew by 5.4% GDP, and you think, man, this is awesome. I can't believe we kicked that COVID crap pretty quick, man. We're already 5% ahead. Well, no, we lost more than that the year before. We're not even back to break even. We're not even back to 2019 numbers yet. Does that make sense? So make sure you understand the data that you're reading if you dig in and use some of the sources. I'll give you all my sources at the end. There's a slide, it's like 30. But if you start digging in, make sure you understand, what are they basing this on? What are we actually looking at? So it says GDP growth is expected to hit 5.4 this year. I'm sorry, for last year. Why am I saying expected? And we're already 3 months in, because the data isn't complete yet. This is an estimate from the US government. We won't have the actual numbers till next month. But if it does hit the 5.4 that they're expecting, it'll still leave us 6.5% below pre-COVID numbers. Okay. So everybody thinks, man, we've just gone crazy good. Well, I mean, we're better, but we're still not back to those pre-COVID levels in many of these things. This one in particular, jobs. Houston MSA, I put all the jobs for the last 6-7 years, whatever. 2021, we added 151,800 jobs. It was an all-time record. That was a headline. All-time record job creation. But look at the year before it and tell me, the year before it, we lost 141,000 jobs. So yeah, it was an all-time record, but you can't shut the world down, close everything down. Everybody loses their jobs, and then 200,000 a month go back to work, and you cheer. You know, we're still way below where we were pre-pandemic. This year, most economists are predicting about 75,000 new jobs in 2022 in Houston. I'm going to deviate from them at the end here. I think we're going to be light on that. Here's the gap. So all the jobs we lost during COVID represent the whole pie. The blue is the ones that have been recovered, and the red is the ones we still got to get to. And this was through February 2022. Now, for those of you that are really good math guys, you might find contradictions in numbers on these slides. It's because a lot of this data comes from different sources and it don't match. Okay, I'm just giving you all the stuff that I can bring you. It's up to you to decide which one, but they're all close enough that honestly, unless you're just anal and have to have something to complain about or figure out, it don't matter, right? They're all going to be real close, but we've still got about 16,000 to go through February to get back to the pre-pandemic level, which if you think about what the economy went through, particularly in Houston proper, that's not bad. That is not bad. I think it's actually pretty resilient, to be honest. Houston ranked 27th last year in job growth with a negative 2% job growth. Now, that was the Houston city itself, not the Metroplex. So the Metroplex we saw did really well. Houston City still lost. You can draw your own conclusions at why that might have been. I'll just leave it there. For February 2020 through November 21, again, not all statistics are annual calendar year either. I get them as close as I can, but sometimes what is fascinating is if you looked at the Houston ranked 27th in the nation among the major metroplexes for job growth, but Dallas, Plano, Irving ranked 4th place in the nation at 4.1 positive. Fort Worth, Arlington ranked 5th place at 2.2, and San Antonio ranked 9th place at 1.3. So 3 out of the 4 major Texas metroplexes ranked top 10 in job growth, which is just awesome, and that's the way it should be. The rest of the country just needs to figure that out. Texas at a glance, second largest state by size, second only to Alaska, second most populous state, second only to California. But we had the largest annual and cumulative growth in population last year. 310,000 and 382,000 people moved to Texas, depending on how you want to calculate it. That put us real close to the 30 million mark for people in Texas. And they are not moving to the country, guys. They are moving to the 4 metroplexes, right? You found them on I-45 on your way here, guarantee you, again, right? Texas jobs ranked 6th in the country in job creation as a state. And that is very misleading and deceiving as well, because it's such a large state. They calculate it by percentage. Well, we got to do a heck of a lot more than everybody else to get to the same percentage as, say, Utah or Idaho, which was number 1, you know. Yeah, percentage wise, okay, it would be. I get that. Right, 3 jobs and they won, okay? Yeah. Again, it's understanding how to interpret the data. It's not just looking at the data. Texas unemployment dropped to 4.8% by the end of last year from its high of 12.6% that was notched out in April 2020, the month after the shutdowns happened. Inflation. How many of you know what inflation is? How many of you put gas in your car or truck on your way here? All right, then y'all know what inflation is, right? So, government numbers is the CPI, Consumer Price Index. And, and I have friends going like this to me, like, don't even talk about the government number because it's BS. No, I have to talk about the government number. That's what you're going to read in the news. That's what you're going to hear on TV. The CPI says that your cost of living has gone up over the last 12 months, 7.9%. 7.9%. Yeah. Ed, say that a little louder, Ed. It feels like more than that. How many of you would agree with him? Okay. Yeah. So if you gaze at this government number and you say, I'm calling bullshit. I'm calling bullshit. If you want to do that, I'm going to give you a website. I didn't cite any of their stuff because they're a little controversial, but the website is called Shadow Stats. And if you go there, they will talk about why, because this guy gets on how the numbers are actually calculated and why they're calculated, the way they're calculated. And then he calculates it the way it was calculated pre the government changing the calculation in the 1970s. And by that old calculation, you know, it's like, you know, simple math that I learned, like 2 + 2 = 4. And then you've got this new math, like, I don't even understand. I can't even calculate that way. Fuzzy math. Yep. Shadow Stats has it at about 16% per year. I personally agree with their numbers, and I agree with their methodology to get to those numbers way more than I agree with this, because government numbers say that, well, I know your food went up, but we don't count food. Right? So that doesn't matter. And so I know you buy gas or diesel fuel for your vehicle. That doesn't count because that's volatile. So we can't count that. That's the CPI.
So they just cherry
They strip out those two items. How many of you have seen your food bill go up? How many of you have ordered a freaking hamburger and a fry and went, no, I just wanted one? When they told you how much you owed, you're like, no, just one order, not two. There's just one of me and I'm not that hungry, right? Yeah. So they strip out food, they strip out groceries, they strip out energy costs, all energy costs, not just gasoline and diesel fuel, also your energy costs at home. That's all stripped out as well. And by doing that, they can make you feel good that the cost of living is really only increased less than 8%. I'm not saying it's a fraudulent number. I'm saying it's accurate. It's accurate for the way it was calculated. It is accurate for the way it was calculated. Figures don't lie, but liars sure can figure. Garbage in, garbage out. By the way, this CPI number is the highest it's been since 1982, the year I was a junior in high school. Taking a look at me, you can tell that was a ways ago. Right? That was a ways ago. I'm really dwelling on inflation for two reasons. Number one, a lot of you younger folks in here don't understand it yet. I'm going to try to make sure that you do. And number two, I think it's here for a while, and we'll talk about that at the end. As I think this is our number one problem. This is our number one black swan. It isn't really even a black swan because we see it. We see it. It's here. And it's going to affect everything going forward for the next couple of years. And you need to understand it so you can get out ahead of it in your business. It's not something to be afraid of. It's just something to be understood. That's all. I'm not afraid of it. I know how to use it to my advantage, and we'll talk about that. Oil, since we're in Houston, we have to talk about oil and the price of oil. West Texas Intermediate is what our oil in the United States is called. These are the prices in January for the last several years. And you can see, I put January of 2021 because all those numbers are January's, and it was 75.57 in January. And that would have been like an eye popper for us, seeing what it's been over the last 3 years, right? But look at today, just 2 months after that, and 102. Now, I say today, I actually put these on paper a couple of days ago. Today, it dropped a little bit, but it's still over $100 a barrel when I looked last today. The energy sector has been in decline for several years. And here's the unique thing about it. This is new. When you got to $75 and $80 oil, Houston used to just kick it in high gear. And I know a lot of oil and gas guys are sitting in this room, and you know this to be true, right? When you get to $75 and $80, it was all hands on deck, open checkbook, let's rock, let's roll. We're putting rigs out, we're doing exploration, we're doing drilling, we're gonna strike while this price is hot, right? That's always been the motto. You see that happen in this time? Those of you in oil and gas? No, it isn't happening this time. Some things have changed. The oil and gas industry is not what it was prior to the last bust a few years ago. It is much more disciplined, and it is much more, for the lack of a better term, Wall Streetified, right? There's a lot more Wall Street money behind it than ever before. And it's going to be much more disciplined. It's not going to jump at every opportunity. It's not going to overspend and go out and lease an entire office building and staff up with hundreds of extra people. It ain't going to do that. It's going to be slower, and it's going to be methodical. And it's because of all the bankruptcies that happened and the reorganizations that happened in the last bust. We talked about that a few years ago. There were a couple slides in there on it. So we're seeing an increase in energy jobs, and we're certainly seeing an increase in activity, but not at the levels that we would have typically seen at this price point. I mean, we're at $100 oil. Are you kidding me? Houston should be on fire right now, but it's not. I don't think it's going to be either. Can't borrow it. No, exactly. Yeah, it's Wall Streetified. Yep. Tighter strings on that money now. Yep. U.S. rig count, I always like to look at the rig count. In 2017, for example, we finished the year at 929 rigs in the United States. That is combined oil and gas. We finished 2018 at over 1,000, and there's currently 650, which is actually pretty good compared to the 400 and something from a year ago. So it has come up, but again, we should be over 1,000 when you got $100 oil, right? They should be just rolling them out everywhere, and that's not happening. That may be a good thing in the long haul. It may be better than the boom and bust that we've had for the last how many decades. Production numbers. This slide just irritates the living heck out of me. But we declined again in production last year. We were completely energy independent at one point a couple of years ago in this country, which meant we produced more than we used as a country. Seems like a pretty good idea, but we got politicians that don't think that's a good idea and are trying to get us to go buy Volts and Teslas by squeezing the energy industry and making gasoline prices high. One of our previous presidents on tape actually told the plan when he said gas and energy prices necessarily have to rise in order for us to transition to a green economy. That is a fact. That is a fact. Yes, you can look that up, find it on YouTube. So it's all part of the plan. You squeeze the supply, you push the price up. Well, if the price goes up enough, you might go look at a different vehicle that you wouldn't have looked at before. That's the whole idea. We were at 12 million barrels a day. We went to 11.3. 2021, we went to 11.2. And today, our leaders in Washington decided that the way to bring down gas prices was to release 1 million barrels a day out of the Strategic Petroleum Reserve, and that would fix our problem. I'm not getting political. I'm just stating facts. The first 40 slides, I'm stating facts. At the end, I'm going to give you my opinion. Okay, I haven't even given you my opinion yet, right? But these are facts. These are absolute facts. Look for there to be a huge fight in Washington over whether we return to energy independent or not. It's going to be a fight. There's going to be a fight, and there's going to be an election later this year. And being Houstonians, it might do you well to learn these topics and learn which people vote which way, because it's going to matter. It's going to affect your life. It's going to affect your business. I don't think releasing oil from the street, 1 million barrels a day for a few days is going to change the price of gasoline. What it will do is it'll drop oil prices for a while, which it did today, by the way. As soon as that announcement was made, that oil price dropped about $1 on 100. Okay, so that's 1%. So if you take that and if you were to get that extrapolation all the way down to the gas pump on $3 gas, you would have saved 3 cents a gallon. And by the way, you're not going to get that extrapolation all the way down. There's too many hands in that cookie jar before it gets to the gas pump. Okay, you're not going to get that all the way down. So, yeah. Let's look at spending on oil and gas. This is something I always want to look at because, you know, we talk about upstream and downstream, right? Most of you know which is the difference. What is upstream? Exploration and drilling, right? It's before it comes out of the ground. That's upstream. Downstream is what? Refineries, the refining of the oil once it gets out of the ground, right? So the upstream spending survey done by Barclays is very fascinating. What they do is they will survey all the exploration companies to try to find out what if they plan on spending any more money, and if so, how much? How much do you plan on spending this year? And they decreased CapEx last year, that is capital expenditures, by 22%, but they expect to increase spending this year by 28%. That's a phenomenal number. So those of you guys on the drilling and exploration side, that may bode well for y'all. We're going to start. I mean, they can't help it when you're seeing $100 oil. They can't help it. Will it go crazy like it did the last time? Probably not, because of the constraints we talked about and their funding sources. But there's going to be more jobs. Going to be more jobs on the upstream side, no doubt. Let's talk about the port system. You know, I always like to cover the port. The United States has 450 ports. Houston is ranked second in the nation. The only port that does more cargo than we do is New York City's port. It's the only one. And we are number one in international cargo. We even beat them on international cargo. The Port of Houston continues to expand and reinvest in terminals throughout the area. The Barber's Cut terminal recently doubled their gate area. Get onto the port website sometime and just read some of their press releases. It's just amazing what they're doing. It's amazing the turnaround. You know, they're dropping their time, what they call the turnaround time, when a truck goes into that port to the time it leaves with cargo or leaves empty, whichever way it was going. They've got it down to 48 minutes, 48 minutes a truck now. And they've been working for a couple of years on that statistic to get it down as low as they can and be as efficient as they can. They are very, very efficient and proficient in our port system. It's fascinating. The Bayport terminal is getting 3 new cranes. They are going to be monsters, 158 feet tall, for a total cost of $35 million for 3 cranes. And by the way, they are actually going to be in service this month. So this has been something I've been watching for a couple of years. Project 11 is completely funded now and underway. For those that don't know what that is, they are dredging and widening 11.5 miles from the Gulf up to Redfish Island, which is in the Houston Ship Channel, just off the coast of Kemah, roughly. And that's going to be widened out and dredged deeper so that we can bring those Panamax box ships. They're like twice as wide as the normal cargo ships that come in. And those are going to be coming in the other way. They're going to be coming in through the Panama Canal. And guess what? We're the first port when you come through the Panama Canal. Houston is the first port. So that's going to bring a lot of extra activity to us. And I'll show you some of the real estate implications of that here in a minute. You know, just a fascinating number here. 52 million tons of cargo went through that port system last year. And that was an all-time new record, more than any other year ever. The previous record was 48.2 millions in '99. So the port is growing. Warehouse space. So we talk about the port system and all this cargo that's coming and going. You think there might need warehouses for it? Where do you think it goes when it comes off that ship? They don't just slap it on a rail car and send it to its destination. A lot of this has to be warehoused. And warehouses has been growing and growing and growing in Houston. When you go out, 99 or Beltway 8 South, and you see all these huge concrete buildings going up, just massive acres and acres under roof. That's what we're talking about. We're talking about warehousing. You go over to southeast of Pasadena, between Pasadena and it'd be Seabrook on Red Bluff. It's just warehouse after warehouse after warehouse, 2 and 3 acres each. That's for the port system, because that's real close to the Barber Cut and the Bayport terminals. So warehousing, we added 5 million square feet last year, and they've got 7.3 million square feet under construction for a 2022 delivery. That's how much investment is going into this port system. These are real estate guys, big real estate guys, most of them, that are betting on those big container ships that I was just talking about. They got to have some place to put that cargo. So they're putting them up, and they're putting them up everywhere. Port of Texas City is the 14th largest port in the nation. And by the way, all it does is petrochemical. It doesn't do boxes. It doesn't do cars. It doesn't do tractors. All it does is petrochemical. Galveston Cruise Terminal is the 4th largest in terms of passengers a year in the nation, and it's #1 on the Gulf Coast. And I like to look at this port system too, because there's been an enormous amount of investment there. Investment just means more jobs, right? So I love seeing new projects. That bodes well for the city. It bodes well for everybody, because the rising tide raises all ships, not just a few, right? So this fall, a 3rd terminal will be finished in the Galveston Cruise Terminal system, and it is being done for Royal Caribbean at a cost of only $100 million. And it is going to be built to handle the new Oasis class ships. And we have one coming this fall, and it will call Galveston its home, and it'll cruise from there. And fortunately, just yesterday or day before, the federal government changed all the mandate stuff on cruises and cruise lines. So it's going to make it easier for people to get back to that activity should they choose to do so. This project, just so you understand why I look at all these things and why I think they're important, that project created roughly 400 construction jobs during the construction of it, and it will create 400 ongoing operational jobs to run it and man it after it's created. So these little $100 million projects mean something in terms of job creation in the economy here and in real estate. Exactly. New projects, other than the ones I mentioned, I love to go in and dig around and see what's coming. So, man, I don't care what part of town you live in, there is something new going on. Houston is hot, and I don't know what I just did. I didn't do it. There we go. There we go. Okay. Must have just sat too long. So, who knows what TMC3 is? Yeah? One guy. Okay. 2. TMC3. Yes. Texas Medical Center, 3rd phase. Yeah. Huge, huge development. Only 1.8 billion. That's with a B this time. Dollar investment for phase 1 of the project. But it will it'll be completed here in the next these were all in the next 2 years will be completed. 6 million square foot development. East River, how many of you know about that project? Yep, a few more. East River project is a $2.5 billion project. Phase 1 will cost $2.5 billion. They have many more phases after that. That project, phase 1 should be done by 2023, but they don't think the whole project will be done until 2028. East River, that is on the north bank of the Buffalo Bayou, east of town. Yep, same people that did City Center is what I read. Yeah. Magnolia Village Master Plan project up in Magnolia, the Frito-Lay plant expansion, $200 million project in Rosenberg. Hewlett Packard's new headquarters. That's 440,000 square feet of space. It's a campus with 2 5-story buildings. I don't remember where. Good question. I don't remember where. The Katy Boardwalk, new project there, obviously where that's at. Great Wolf Lodge is building in League City for those of us on the south side. Yep. Great Wolf Lodge, they'll be building back in behind Top Golf off of I-45. Yep. Just south of League City, between League City and Dickinson there. City Place. That's another master planned huge project at I-45 North and the Grand Parkway. Bolivar Beach Club and RV Resort, obviously Bolivar Peninsula. The Montrose Collective, that's a fancy schwanky deal down in Montrose area. Oh, I just looked at the pictures of that. I'm like, I would never even walk in there. It's too fancy for me. I would feel weird in that place. Cypress Green in Cypress, obviously. These are all new projects that are already broke ground or permitted to break ground and are under construction. Yeah, it covered the whole area, literally. And there were more. I just cherry picked what would fit on one slide. I could have put another slide full, but I just cherry picked, you know, some of the new projects that I thought would be of interest tonight. Another metric I like to look at is the Purchasing Managers Index. December 21, that index was at 57.8. That was down from 60.3 in November, and it was down from 61 in October. Now, that particular index, you don't want it to go down, just like your computer. You don't want it to go down. I literally did not touch anything. Yes, I have it on my laptop. Y'all just, that doesn't do you a bit of good though. That's a good, yeah, thank you. I'll kick all the electrical cords and see if anything happens, but shift key, okay, do that. I'll start punching buttons here and HDMI, you think? Okay. Well, so I'll talk about the Purchasing Managers Index while he's doing that. So why do I look at that? This is a survey. A lot of these statistics I look at are surveys from people that are on the cutting edge of our economy. And they know what they think is going on, and they know what they're going to do as a purchasing manager, right? So the Purchasing Managers Index is, call Linda, she's purchasing manager for a large corporation, and we ask her, how do you feel about things going forward? And gauging her, right? If she says, oh man, we're all in, we're bullish, we're going to be spending X number of dollars, blah, 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 that makes that number go up. We want that number to go up. If she says, man, I don't know, things are pretty crazy out there right now, we're just kind of going to hold off this year, I think. That makes that go down. Now, why does that matter to us? Well, if big corporations don't spend money, guess what? We lose jobs, right? Now, big corporations start spending tons of money, we create jobs. So this is a really good leading indicator of where things are going. And what do you notice when you look at this? The way, and I put it this way intentionally, so it would be very obvious for you. We have 3 months of decline on a key leading indicator. Yeah, 3 months of decline. I'm sorry? There's a ton of supply chain issues. Yeah. If you're a flipper in the room and you're trying to get appliances, how easy is that been, right? Not easy. Or if you needed a new car or a used car, worse, a used car, right? My daughter is trying to get a used car because somebody T-boned her in an intersection. Nobody was hurt, but the car was totaled. It really wasn't though. But they couldn't get the parts to fix her car. They had her in a rental car for 3 months and still couldn't get the parts to fix it. So the insurance company decided it was cheaper just to total the car and get her out of that rental car. Yeah, yeah. Crazy, crazy. Yeah. So any reading above 50 is still considered expansion. So it's not alarming where we're at 57, but I don't like the trend. So I just wanted to show it to you. Consumer Confidence Index. This is one I really like. Again, it's much like the Purchasing Managers Index, and it measures the pulse of what people think. It does not measure what is, it measures what people think. Why do you think that's important? Because I do. I think it's very important. Perception is 90% of reality, particularly in the economy. If you don't believe me, we could do a study and we could have all the major medias go on and say, real estate's crashing. Oh my gosh. This horrible time, real estate is crashing. And I guarantee you, real estate will crash. Not because real estate was crashing, but because it gets in the psyche and people start playing defensive. Oh, wait, well, it's crashing. I mean, man, maybe I better get away from that. So people's perception matters. If people are not confident in where they stand financially, they won't spend as much money. Would you agree? People take a defensive, I mean, any logical thinking person would take a defensive position. So we don't want that. And right now where we're at, we are at 107.2 is our current level as of last month. But again, look at the trend. We were here, and now we're down here. I don't like the trend. That's all I'm showing you. Come on, there we go. Unemployment insurance weekly claims report. Really low. We're down here, 211,000 for new claims. This is something that you know, there's two unemployment numbers that you want to look at. New claims and ongoing claims, right? So the new claims, we're at 200,000 new claims for that particular week. That's the last week that we have numbers for. And you can see the trend line there. Obviously, the peak is probably April of 2020, right? During the height of COVID when everybody was losing their jobs. And then we slowly kept bringing it back. And you can see these dots are extra weeks. So, I mean, there's a huge difference from there to there and to there and to there. Then we started really packing the dots in. We're still making progress, but not quite as fast. And we've got it down now to basically, if you're unemployed today in the United States, it's probably because you want to be. Okay, let's just call it what it is, right? I mean, because I'm going to get to a slide here in a minute that is just going to prove my point unequivocally. So, unemployment rate from age 25 to 54. This is another way to look at it, really showing you the same data just from different perspectives. Labor force participation rate. This is different than an unemployment rate. So back a couple of years ago, when we had an unemployment rate that was like 3%, right? But we still only had a labor participation rate that was in the high 70s. Well, where'd the other 30 go? If everybody's got a job, how does, you know, and I'm like, well, here's how. There is the people that are unemployed that are applying for an unemployment check, That gets counted in the unemployment numbers. And then there's the people that are unemployed and they're not asking for a check. That's labor participation rate. Everybody see the difference? So the labor participation rate is climbing, but I'm not so convinced that that's actually for good reasons. People that don't hold a job and they intentionally don't hold a job, and they're not asking for a check, they just don't hold a job. They're doing something else to live. Would you agree? There's got to be income coming in from somewhere. This could be under the table job. It could be they're a handyman. Could be a lot of different things, but those are most generally a lower paying job. Would you agree? When those people are pushed into the labor pool, there's typically something doing it. It's not that they just woke up one day and said, you know, I think I'm just going to go do a W-2 thing, right? There was something that pushed them to that decision. So seeing that go up makes me wonder, is inflation pushing people because of the cost of living increase to take jobs with a W-2 and more stability rather than just work in a gig economy? It's just a question. Or doing both. Yeah. And when I dug into the unemployment numbers and the employment numbers, a lot of the job creation that is being counted is part-time work. A lot of it is part-time work. Even though the jobs that were lost, most of them were full-time. A lot of the new ones coming back are part-time work. Again, got to dig into the stats and read the numbers behind the numbers. So it's not as rosy as it might appear on the outside. Labor force participation rate since 2000 by age group. Now this was fascinating. Look at the orange line here. Anybody that says the old people, right? The old people are dragging society down economically. 65 and over is the orange labor participation rate. People that are 65 and older are working at a higher percentage to the population than ever before. Could be, you know, they're working though. They're working somewhere. The next group down is that blue, the kind of a medium blue line. That's the next cohort, which is 55 to 64. It's my age. The 55 to 64, they're growing, but not quite nearly as fast as the people in the 65 and older. And then the next three cohorts, they're just running neck and neck, but their participation is lower over the last 20 years. You can see they're below the median line. And then y'all 16 to 24, I don't know what the hell you're doing. I mean, yeah, exactly. Yeah, exactly. They're living with the, yeah. Just saying, what this shows me, what this is showing us is that society is changing in a lot of ways and habits are changing in a lot of ways. You know, I'm not going to stand here and say, well, when I was your age, you know, when I was growing up, but really when I was growing up, we had jobs at an early age. There was no choice. Some of you are going, yep, me too. I'm not saying it's right. I'm not saying it's wrong. It just, that's the way it was. When my kids were 16, if they wanted to get a driver's license, they had to have a job. Because I don't know how they were going to help pay for the car insurance if they didn't have a job, and they were paying towards the car insurance. They were paying $50 or whatever we charged them. It was just to teach them that everything has a cost, that this stuff doesn't grow on trees, that there is a cost to you having a driver's license. And I don't think some of those lessons are being taught today. It's obvious by that light blue line on the bottom that those lessons are not being taught today. So how does that impact us economically? We don't have enough workers. That's how. We have a shortage of workers in this country. We don't have enough workers to fill the available jobs today. I'll show you in a minute. If we could get some of that bottom line there to go to work, it would help. It would fix it, but it would certainly help, right? So everything has a cause and effect when it comes to the economy. Worker shortage, there's the slide. The United States currently has 11.3 million job openings. I said earlier, if you're unemployed, it's because you want to be, okay? Because there is 11.3 million jobs currently open to pick from, and I have 5 of them. Come talk to me if you are unemployed and you're serious about not being unemployed, okay? And every other business owner in the room probably has some available too. I don't have a single friend that has a business that doesn't have at least one opening today. We can't fill them, which means we can't grow. Does that make sense? We can't grow unless you can fill your jobs. So it's a problem and it's a constraint on the economy. It's going to keep the economy from growing at its full potential because we can't fill the jobs and grow. 6.3 million people are unemployed. We could take every one of them off of unemployment and just stop checks today and make them go get a job. I'm not saying that's a good thing. I'm not saying we should do that. But if we did do that, we would still be short workers. We would still be short by half almost. And this was an interesting statistic. I'm fascinated by the whole work from home idea, right? 2020, a lot of people and a lot of companies thought office buildings like this were dead, right? Now, I was hoping they were wrong because we closed on this building in January 2020. Yeah, great timing to buy an office building, right? March comes around and this is a ghost town. I mean, I'd show up here and I didn't have to fight for a parking space like y'all did tonight. It's like I had my pick because there was nobody here. And a lot of people were saying people aren't going to go back to the office because now we have all this technology and we've learned how to use Zoom. You know, we've learned how to do all this stuff. There's no reason for technology, or excuse me, there's no reason for the office. We're going to save so much space. Facebook, Twitter, Google, Amazon, B of A, all these big companies, particularly in the tech industry, but some even in the banking and finance industry, were abandoning their buildings. They're still paying their leases, obviously. They had to, they were under lease. But they were just abandoning the buildings, setting everybody up with their computers at home and letting everybody work from home. And my buddies are going, Tom, you scared? You scared? You just bought that building, you scared? And I'm just like, no, this isn't gonna last. Now, how did I know that it wasn't going to last? Because I know human beings. It's the only thing I know really, really well. I know people really well. And I know as hard a worker as I am, as honest as I am not going to work at the same full productive potential in my house with the distractions that come along with that as I would if I were in the office with my peers looking over my shoulder and my boss in the next office. So we learned a new word last year, or the year before, rather, 2020. It wasn't a word, it's a phrase. It's called shaking the mouse. Y'all know what shaking the mouse is? Yeah. You work from home? Yeah. Shaking the mouse. So the technology that allows work from home is fascinating because what it does is you've got a camera and it monitors your activity, yeah, your movement. But if you get up and you go put the laundry in and make yourself a sandwich and check and see what's happening on the soap opera, right? You got to run back and shake that mouse every once in a while so that the computer thinks you're still there working. Otherwise, it's going to trigger. Yeah. See, there's an app that shakes the mouse. Yeah. Now, the fact that y'all are laughing and you know this happens proves my point that this was never going to work. It was never going to work. Now, am I totally against work from home? No, I have some of my employees that only work from home and have for years before COVID. Our IT guy lives in Pickerington, Ohio, and handles all of our IT for all of our companies. He can work remote. If I have a computer problem, he remotes into my computer, he takes it over and he fixes whatever. And I talk to him over the speaker and it's done. He can remote. My legal director, she's amazing at what she does. I didn't want her in an office because she gets bothered. She's handling legal docs and having to concentrate. She doesn't need bothered with stupid crap. I told her, go work from home. How would you like to do this? She's like, that'd be great. I wouldn't get bugged. Perfect. She's worked from home for years. So I'm not saying it doesn't work. I'm not saying it can't. I'm saying it's not going to be something that's going to be as prevalent as what people thought it was going to be. And here's my proof. As of February, it was down to 13% of workers said they did any type of work from home or telework. And that number has been falling precipitously. Now, all the tech companies are bringing their people back. B of A has brought their people back. But now they have a problem. Again, human nature. What's their problem now? Well, yeah, trying to get them back. How do we get them back? They don't want to come back. Well, no kidding. No kidding. You gave them total free. So that's a problem. And it's also adding to the worker shortage because a lot of people are saying, you know what? I do interviews constantly and I put it in the ad. This is a office setting, big bold print, office setting, not telework, not work from home. I'll get through the telephone interview and right at the end, right when we're almost done, they'll say, I know the ad said, but, and I'm like, no, it's an office job. There is so much benefit and value to working in the office and collaborating with the other people that are working on the same project you are. Yeah, we lost a lot of that over the last couple of years and we lost a lot of productivity over it, but I think it's coming back. Yes. I don't have any data on that, but that would be an interesting statistic to see if people are striking out on their own more and, rather than taking a W-2. So let's get to the real estate part. That's the part you really came here for. Foreclosures. Now, 2020, everybody, not everybody, but a lot of people were saying we're going to have a tsunami. Going to be a ton of foreclosures. It's 08 all over again. And I argued that and said, no, it isn't. Yeah, but there's millions and millions of people not paying their bill. Yeah, but it don't mean they couldn't. It just means that somebody gave them the opportunity not to and they took it. That doesn't mean they can't pay. Just like people not paying their rent doesn't mean they can't pay. They just had the opportunity to choose not to pay and took it, right? There are a few, obviously, in both scenarios that couldn't, but there's the data on foreclosures. It has just continued to fall and fall. Now, I understand the 2020 drop because we weren't allowed to foreclose. Again, we lost our property rights in 2020, but we did get them back in 2021. And we have been able to foreclose now for quite some time. So where's the tsunami? No tsunami. Why? Say that again, Norm. The houses are worth too much to be foreclosed on. If a person is foreclosed on today, it's just because they were in denial about their situation. Because if you were about to lose your house, Ed, what could you do? Sell your house. Even if you couldn't refinance, I mean, obviously that would be your best option if you could. But let's say that you were in a position financially you couldn't refinance. You could sell it and walk away with probably a pretty significant chunk of cash. Because inflation and property rise in value even before the inflation really took hold has been phenomenal. And it's all across the country. It's not just here. I speak all across the country, guys. I've been to all four sides in the last 12 months. And it's not just Houston. Everywhere it's like this. Pretty much. I mean, you get to rural areas, obviously it's slower appreciation, but in most of the major markets, housing prices are through the roof, and lending guidelines have been more stringent since 2009. You put those two together, somebody loses a house today, they would have to really try hard to make that happen, okay? Or just not exercise good judgment. And I get it, there is always going to be a bit of that. But as you can see, it's not much. Yes. Yes. Yeah. Well, the lenders, Byron just rightfully pointed out, lenders are doing a much more proactive job at not foreclosing. Number one, because they're being forced to by the CFPB, and their somewhat ridiculous guidelines. But even at that, they also learned some lessons from 2008 and 9. They learned they didn't really want a lot of foreclosures because they, those lessons stung. So there was a lot of working with even before the new CFPB guidelines came out. Houston apartment market, 37,000 new units were delivered in 2021. There's 15,000 new units under construction, another 31,000 units proposed. That's the order in which it happens. Occupancy, as I said earlier, I alluded to it, it is at 91.8% occupancy as of Q4 2021's end. And that is a phenomenal number for Houston. As many new units as we deliver on an annual basis, that is incredible absorption. That's what it's called, is absorption. When you bring new units online and they are absorbed into the market and they don't crash your occupancy rate, that is strong absorption. Rental rates for apartments. Hello, how many of your apartment owners in here? Few? Trying to be, okay. Well, rents jumped 12.8% in 1 year on apartments in Houston. 12.8%. Crazy. Yeah, it doesn't. Yeah, so great point. So think about your tenant who, their cost of living went up in every which way. Yeah, you know the drill. We don't have to drive that home. Interest rates on a 30-year mortgage. This is something that has a lot of people in real estate concerned, but I put these stats at the top to allay your concerns for a while, because I don't think there's reason to be concerned. From 1995 to 2008, the average interest rate for a 30-year mortgage hovered between 6 and 8%. That is a 13-year period. It never went higher than 8%, and it never went lower than 6% for 13 years. And guess what? The real estate market was just fine. The real estate market was just fine. I don't have that on the top of my head. Yeah.
Back then versus 300K now is median.
Yep. Boom, you got a good point. So what happens when, well, you took my thunder, but that's all right. It's good. No, it's good. So what happens? People are worried about interest rates going up and the real estate market is going to crash. That's what I'm talking about here. Is that going to happen? No. What's going to happen? He just said it. Are people going to stop buying houses? No. What are they going to do instead? Buy less home. That's right. That's what changes when interest rate changes. My mom and dad bought their very first house when I was in the 9th grade. In the 9th grade, that would have been 1974. Their interest rate was 12% on their 30-year mortgage. And it kept going up after that. For those of you that are older than me, you know that. There were times when 30-year mortgage was 16%. in the late 70s, early 80s, I believe, if memory serves me. Did people stop buying homes then? Nope, they still bought homes. Yeah, hard money rates aren't that. Right? Y'all complain about that if they would be, right? But interest rates aren't going to crash the housing market, not when it rises to 4%. Not when it rises to 4%. So the lowest rate on record was November and December of 12 at 3.3%. That was until 2001 when it dropped in January to 2.74%. After that, it started coming back up. January 22, it was sitting at 3.45. And you know that recently we had some bumps. Now we're over 4%, 4.24. I say today, not today, a couple of days ago today. But we are not in a place where I think it's going to crash a real estate market. We're not even up to normal yet. There's no inventory to buy anyway, even if you could get a better rate, right? Yeah. That, I think, is the biggest issue, not interest rates. Yes. Will you say that last sentence again? You cut out. So I'll leave the politics clear out of it and tell you that to bring down inflation, we must raise rates. That's not a political answer. That's a straight up actual answer. Go back into history and look at how Reagan stopped inflation. He didn't, but Paul Volcker did. And how did Paul Volcker stop inflation? And he stopped it dead in its tracks in a very short time frame. He raised rates. If you follow Art Laffer, who worked in the Reagan administration and is an economist now, he says that in order for us to stop this, what he calls runaway inflation, I think it's a little premature to call it that, but he knows more than I do, right? What Volcker did was make sure he got rates raised to 4% above CPI. And some of you did the math on that. Yeah. That's 11 to 12%. Yeah. He thinks what our current Fed has done is way too little and a heck of a lot too late. And we'll see. I don't have a crystal ball. I don't think he does either, but he lived through it and he saw it and he knew the players back then. So yes, in my opinion, rates have to rise. And in my opinion, they have to rise a lot and they have to rise fast. And now I'm going to interject my opinion a little early. I don't think the current people in power have the spine to do it. I don't think they have the courage to do it. That is just an opinion, not based in any fact whatsoever. By the way, I would have said that regardless of who was in the White House, who was in the Fed, who was in the Senate, who's running the House. I don't think any of them in Washington, either side of the aisle, would have the guts today to do what needs to be done. That's what scares me most. That if you want to know where I think our problems lie, that's what scares me the most. Single family homes, if you want to look at that from last year, kicked butt in Houston. Doesn't matter whether it was single family or whether it was total volume or whether it was just single family volume, it was new records in every category for sales. And I really didn't even predict that we could hit a record because there was no inventory at the beginning of the year, but we did anyway. So, somehow it made it. The thing that I would look at there that strikes me is look at the difference in the average sales price from 20 to 21. It went up 50 grand. and the median sales price went up 40 grand. That's huge. That goes to affordability. Houston has always had an edge over other major metroplexes because we've always been one of the cheapest in the nation. When I moved to Texas, I'm from Ohio originally. When I moved to Texas 17 years ago or whenever it was, I researched, as you might imagine, 100 different things, different analytics to see where I wanted to go. We didn't just set out to come to Houston. We said we were going to go somewhere. And then I set out to figure out where that somewhere should be. And at that time, Houston had the third lowest cost of living of any of the major metropolitan areas in the nation. The only two that beat it was, in this order, Cincinnati and Pittsburgh. And since I was from that region, there was no freaking way I was picking either one of them. Okay, I wasn't getting any better weather with either one than what I already had. So that was out, right? But what drove that low cost of living? Cost of housing. That was what I read at that time, was the cost of housing was so inexpensive in Houston that it drove the overall cost of living down because it's such a big percentage of our living, right? I worry that these kind of increases may take us out of that and make us not as competitive, because we need new people moving to Houston in order to continue growing the economy. I hope they'll put extra lanes on the freeways for it, right, in a timely manner, but at the end of the day, we need it. We definitely need it. Exactly. It's a supply problem. It's not a demand problem. We don't have enough supply. Single family rentals, leases rose 5.9%, up from 7%. I'm not going to go through all these. You guys are hot, you're tired. You don't want to see all these statistics probably. Here's one that I do have to talk about though, because we've talked about it so much. Inventory in single family homes in the Metroplex of Houston, in the Har region, I call it. 1.3 months of inventory. What is a normal inventory? Yeah, arguably, I think Houston's normal is more like 5, but they say a neutral inventory is 6 months. Yeah, and we're at 1.3 months. No houses for sale, just no houses. Now, I had just told you, it's not just here. Look at the new statistic. Nationally, we're at 1.6. So yeah, we're a tiny bit worse than the national number, but not that much. That's not much either. 1.6 months of inventory. So how many new houses are being built? Well, you'd have to go to housing starts to see what that is. And housing starts in the United States for last year was 1.769 million new houses. So let's do some simple math in our heads here. How many houses are sold in the United States in a year? Roughly 6 million. Roughly 6 million houses sold in the United States in any given year over the past few years. So if 6 million houses are sold per year, that's how many a month? 500,000. I know it's late to do math. If you got 1.6 months of inventory, how many houses do you have? 800,000 exactly. I did the math on a calculator earlier. All right. 800,000 houses for sale in the United States. That's it. Now, what is 6 months of inventory? Thank you. That was an easy one. You didn't need a calculator. 3 million is what we need. We have 800,000. That's how many units short we are of a neutral market. Does that put it in perspective for you? We could build those twice, and it would barely get us to where we need to be as fast as they're coming off the market. So what does all this data tell us? That's the end of the statistics. The boring part's over. Now comes the conjecture. What do we think is going to go on? Nobody's got a crystal ball, but we can come to some reasonable conclusions if we see enough data and we understand the data. Would you agree? So what are some reasoned conclusions we could come to? Now, by the way, we have to preface it by saying any conclusions we do come to tonight might change tomorrow because they are already predicated on things that we can see and we know. They are not predicated on any major unforeseen events like a world war, for example, or COVID, for example, or shutdowns or any of those things. Those things will change everything we talk about tonight. So my conclusions for 2022, nationally and in Houston, job growth and GDP will continue, but I think it will slow from its current pace. Now, when I say it'll continue to grow, keep in mind what we talked about earlier, that's really not that hard because we're just recouping what we already lost 2 years ago and haven't recouped yet. So that's pretty easy. That's a pretty easy prediction to make. I think we'll end in positive numbers, but not stellar numbers. Houston could see GDP growth of somewhere between 2.5 and 3.5, I think, on year over year. Economists are calling for 4.6. I'm a little bit more bearish on it. Wages and salaries are certainly going to continue to go up because there is a worker shortage, supply and demand. We don't have enough workers. So we have to continue to pay them more. I don't have any of my employees in here, do I? Yeah. Look, raises are being given at an unprecedented pace to employees to keep them. They are being given at an unprecedented pace. I predict that wages are going to go up another 3 to 4%. Now, you think, well, yeah, but my cost of living just went up 7.9. I still didn't keep up with, and that's true. That is true. That is always how it works. That is always how it works. That's why you guys are here and not relying on a W-2, because a W-2 doesn't get you there usually. In Houston, I think we could see 60 to 70,000 new jobs in 2022, certainly get us back to pre-pandemic levels, but I don't see how we get to the 75,000 that most of the economists are calling for unless the oil and gas exploration really blows up and they start spending more money than I think they're going to spend. But we'll see. That's why I call them predictions. Houston single family market's going to certainly remain strong. Again, because there's no houses, you're going to have to pay. And we're going to see increases in prices like crazy. Can we set another sales record with only 1.3 months of inventory? I don't know. I don't see how, but I didn't see how last year either, and I was wrong. So I could certainly be wrong on that one again. I think they will continue to rise prices, but they will moderate. I don't think we see the rise in prices that we saw last year because I think we are capping the affordability range. And I think the same for rents. We're about tipping out on the affordability range of what people can pay. Foreclosures will slowly accelerate, but not because foreclosures are going to be a tsunami, only because of the end of the forbearance stuff. This month was supposed to be the end, but like the end of everything with government, there are 3 or 4 possible more extensions on the extensions on the extensions. So, but it is waning, and eventually it should die down to nothing. And moratoriums, obviously, those are over locally, but there may still be enclaves where they still are not allowing people to foreclose. That's a state and local issue, not a federal one. Rental market is going to expand in numbers as households grow. That's obvious. Rates, I think, go up another 4 to 5, which is about half of what they went up last year. But they're still going to accelerate because there is a lack of inventory in rentals as well as there is in single family ownership. If we're short on houses, we're short on houses. It doesn't matter what the usage for the house, right? There's still a shortage. I think wholesalers are still going to get 80% or more on their deals, Ron. You're still going to be able to overcharge and people are going to pay it. Yeah, see, 95% deals, right? We're still going to see it because there is a lack of deals. And if you want to get in, you got to pay. It's just the way it's worked for a couple of years. Interest rates are still going to climb, but I don't think they're going to reach our historical norm, which is 6 to 8 this year. I don't see any possibility of that. And I think that's unfortunate. I think that's unfortunate. I think we should. Because if we don't, we're going to see, in my opinion, runaway inflation. These are my opinion slides, guys. These are not the facts. My opinion is if we don't see rates rise and rapidly and a lot, we're going to continue to see inflation run. We've got supply chain issues like we've never seen before. Somebody mentioned globalization. I would argue there's a deglobalization going on as we speak, because a lot of, particularly industry, learned that having your manufacturing halfway around the world might not be the best for you. You know, my wife and I bought some cabinets for our lodge at the ranch, and we were redoing the kitchen. And I'm like, man, it's gonna be like 9 months before we're gonna get these things, because you can't get anything out of China. And you know, I'm not paying. It's a lodge, right? I want the cheaper stuff. So we go in, and the guy's like, no, one of our he's like, all of our Chinese manufacturers, it would take you 6 months, 9 months to get them. He said, well, we have one manufacturer that as soon as COVID hit, they moved their plant to Mexico. And he says, I can have you that stuff in 2 to 3 weeks. Yeah. I was like, no kidding. And it was really good quality, good looking. So that's what we did. So I think interest rates are going to climb. They're not going to climb enough, and inflation's here for a while. Multifamily, I think right now cap rates are just extremely low. I don't expect that to change in 2022. Again, there's nothing on the market. There's just nothing out there. I think apartment occupancy may slip back to 89 to 90%, but big deal. It's a percent or two. It's not that big of a deal. It's not going to change cap rates in any way. And the only reason I think that is because of the amount of under construction. They're going to be finished in 2022, but we could absorb that too. Who knows? But it's not going to be any major changes. We all know the apartment market will turn at some point, and we'll be able to buy deals again on it. It ain't going to be in 2022, in my opinion. Don't know when, but I don't think it's going to be this year. Potholes, things to look out for. I think this is a transition year. I think we're headed into some territory that many have not seen before. And if you did, it was when you were a kid, like me. Home sales may level a little bit because of lack of inventory, but not lack of demand, that's for sure. That reduced inventory on the wholesale side could lead less experienced flippers to overpay to get a deal, right? And we've seen a lot of that in the last 1.5 to 2 years. I think inflation is the next big problem. We've talked about that. Persistently high inflation. Here's what could slow the housing market. There's probably other things, but this is the scenario that I see as most likely to slow the housing market. Persistently high inflation slows consumer spending because you have less dollars in your pocket to spend, right? So you tighten the belt and you don't spend as much. You don't get on Amazon as much. You don't do whatever it is that you do. You don't go out to eat as much. You know, we can all tighten our belts, right? And you start doing that, that hurts Wall Street and it hurts Main Street. It hurts the restaurants that you don't go to anymore as often. It hurts the products that you don't purchase on the internet or at the big stores that you go to. And then that triggers layoffs because they're hurting. What do they have to do? Well, they got to tighten their belt just like you did a year ago, right? So they tighten their belt, they start laying off because what is the number one cost of most businesses? Payroll, right? Payroll. In my business, in my lending business, my number one cost is cost of funds, right? Because we borrow or attract money, and we got to pay for that. But our number two cost, payroll. 40 or 42 employees, it's a big number. It's a big number, and it's that way for every business. So then they start laying off people, which then exacerbates the problem because now you have people that have even less money to spend because now they don't have a job. And that's when they stop buying houses. That's when they stay put. That's when they stay in the rental and they don't go out and buy. That's the most likely scenario I see for a housing downturn. And I don't think that happens and plays clear out in 2022. Could it? I don't know, maybe, but I don't see it in 2022. But I think 2023 is going to be a real interesting ride. I think that one's going to be a real interesting ride. So that is my take on last year and what we have this year. I'll take a couple of questions and then we'll close it out and turn it back over to Steve. No? Going once? One question, and I'll take one more if there is. Okay? Having your powder dry. Yeah.
Is that still a thought process?
It is a thought process. Here's my recommendations. What should you do this year? And by the way, this slide, for those of you that don't realize it, are the same every single year. I don't change this slide because what you do is the same every year. You make a plan, right? Based on the information and the things that we've shared here, you make a plan going forward, and then you go to work and execute that plan. Stick with the successes that you've had. You build simple systems, try to systemize your business. Don't bite off more than you can chew. I always say I built my career on singles and doubles. I have very few home runs in my career in real estate, but I got a shit ton of singles and doubles. That
Hey
is,
guys, I see a lot of questions. It's pretty much 10 o'clock at night.
yeah.
We gotta get going, guys.
Yeah.
So I do apologize. So Tom, you're gonna have to close it up.
All right, sounds good.
So no more questions, guys. Thanks, sorry. Any last minute comments real quick, Tom?
Nope, there's my sources.
How can people get a hold of you?
There's my email. If
Tom?
you got questions, sources back. There you go.
All right, guys, hey, let's give Tom a great big hand.
Sorry it went so long. It's a lot of data.
Great information. I mean, did that help everybody? We've got a pretty good idea of what we need to do, what's going on. Realistic standpoint, so. Bye, everybody. Well, thank you.